YieldMax is changing their strategy with this new set of ETFs targeting 25% in distributions. Will this prevent NAV erosion? Will these actually grow in price value? Only time will tell. But today we're going to take a look at those three new ETFs and see if they have what it takes to reverse the issues going on with YieldMax and causing people to sell out of their ETFs at a pretty quick rate. So I hope you guys do enjoy. My name is Spencer and I talk all about ETFs and investing. So don't forget, if you want to grow your portfolio, to like and subscribe. Now let's get into the video. We are going to cover three main points in this video, starting off with, of course, these new ETFs. What's different about them? How do they work? And what is the target investor when it comes to this newer style of YieldMax ETF? They do have three of these out already. They have MSST, NVIT on Nvidia, and TSPY on Tesla. Our first one we're looking at is, of course, the MSTR fund. Second, we are going to take a look and see how these differ specifically from the past performance of YieldMax. Why are they making these funds and why now? And last but not least, I'll give my opinion on these funds and we'll take a look at the underlying performance and see exactly what the underlyings have been doing to see if these were a good selection for this new Target 25 ETF. And so there's a lot to cover. Let's start. We can actually see they have a number of reasons why you would choose these funds, and they're kind of similar to what YieldMax normally puts on their websites. We have, it's going to be designed for income and growth. This is already a big difference because YieldMax funds have never been growth at all. They've always talked about growth, but they very rarely actually do well in the growth perspective because of something called NAV erosion or NAV decay that's caused by options. But we'll get to that in just a moment. They're saying that this fund is designed for income and growth. It's going to generate consistent weekly income while maintaining meaningful exposure to the performance of strategy or MSTR. It's going to aim to balance both income and potential for NAV growth over time. Now, I want to say this Target 25, they have it listed right here, is not a guarantee, and it does not represent a 25% yield or total return. That is kind of the goal. And that is, again, just yield. Total return is going to be very, very different. They're saying that it's an evolved income strategy, but we do have a lot of other competitors that already utilize funds in this way. Roundhill has XPay, RecShares has CEPI, AIPI, FEPI that are targeting 20%, even if the strategies are slightly different. Both of those competitors also have funds that focus with some leverage involved, like with Rex. They have leveraged and income combined into one fund. We have Roundhill that has their just leveraged funds that pay every single week. So we'll see if this one really can keep up with the competition. And last but not least, they say I'm going to be honest, I figure 0.3 is mostly fluff. With markets demanding flexibility and discipline, MSST employs a modern framework designed to adapt to changing conditions, manage risk thoughtfully, and pursue both performance and distribution goals in a single unified ETF. It's not new, but it's new to YieldMax. And what it's really going to come down to is, are they actually able to do this? So we'll have to track it. And I will be tracking these 100%. But it does still make me a little bit nervous that they chose these three, because MSTY, Misty, is their most popular fund, but it has been bleeding for the last 6 months. And with the fall of Bitcoin, it's only going to continue to fall. Now, I'm not saying that I think Bitcoin is done. I do think Bitcoin will rebound, but it's just a little bit interesting that they would choose MSTR as one of their main starting points. And this comes after a time when a lot of people have been moving money from YieldMax for the issue of NAV erosion. So we're going to touch more on NAV erosion. Let's take a look. I need to start out this by saying YieldMax lets us know that in their name, YieldMax, their goal is at the forefront of the company. They want to get us the maximum amount of yield possible. And that leads to NAV erosion. It genuinely just does. And I even made a mistake in my last video talking about that how if everyone reinvested the dividends, the NAV would remain consistent. But that's not true because there's an outflow of money from the NAV and then people have to decide to reinvest that. But even if they do reinvest that, it's not going to directly impact the NAV like it would with a normal stock or a normal ETF that's going to have the NAV fluctuate. It's going to do supply growth over time or a decline over time. And so it's really interesting that they're choosing to go this way now. The Target 25, we're looking at the NVIT, the Nvidia fund, which is probably my favorite of the three, I will say. I like Nvidia. I mean, if we have an AI bubble pop, they're all going to fall. But Let's take a look. Because one other key point that is different with this fund is the fact that they are going to then sell call spreads in an effort to create weekly income. So call spreads are different with their single income ETFs, their single stock ETFs, I should say. They are generating the maximum amount of yield possible. And they tell us that, again, in the name. It's yield max. They generate the yield and they send it out to investors to get them high yields. And because of that sending out of tons of money, tons of yield, you have NAV erosion. And it's kind of funny as well because NAV erosion is actually kind of a term that YieldMax coined. They specified, I think it was in one of their announcements or in one of their, I can't even remember which document it was, but they talked about NAV erosion or NAV decay, NAV decline, and the internet kind of took that and ran with it. And now they don't like that term because it is an important term for investors that are seeking income but also don't want their original investment to decline. So kind of a bummer for YieldMax for kind of creating something that then defines their funds. Now, particularly with this style, I'm curious if they are able to keep up a 25% yield. They may have it be a little bit above, a little bit below, but all of this is really going to come down to the growth aspect because they're not going to be able to utilize the full repertoire of ways that they can make high yields with other ETFs that they have, like with Tesla, with Coney, with Misty, because they're trying to cap that at a 25% distribution rate. And that should solidify the NAV and make it a lot more stable of a fund. But this is all going to come down to one key fact. What options are they choosing to write? And I think this is something a lot of, not even other YouTubers, but a lot of other income investors, we need to remember. A fund is only as good as the strategies employed. And who employs those strategies? The strategists, the fund managers. So you could see a really solid fund start to do terribly because, again, there's a switch up. The strategy has changed and they're trying to do something different. They just simply make a mistake. People think that these are like inanimate objects, but they are kind of like a living thing. And the manager is deciding the actions, which is going to incorporate how the fund does. It's going to dictate if it does well or if it does poorly. So when it comes to YieldMax, we know the NAV erosion is a significant problem. Will this fix it? I did an interview with David Nicholas. He's the CEO of Blocks, and we talked about this because there's no way. Here's what everyone wants. In an ideal world, we want a fund that pays 50% and grows up 10% in value every single year. It's not easy to do because utilizing options is a way to make that happen, but you have to have a very solid underlying that trades the perfect way, and that's just not easy to find. Because if everyone could be super rich off these funds, if they were easy to make, then we already would be. But David Nicholas and I, we had a conversation about Blocks, BLOX, their weekly paying crypto ETF. And I asked him, how much of the dividends are coming out of the NAV? And he said, well, it depends. The goal with Blocks is growth over income. So it's switched compared to these target 25s from YieldMax. They're still targeting first that income and growth as a secondary objective, which again, they've put that on all their different website pages for their ETFs. They always say that they're going to have some exposure to the underlying, and yet we still have NAV erosion because it can't keep up with the overall erosion coming out of the distributions. And David and I, it was a really interesting conversation. I'll link it at the end of this video for those that are interested. He said it changes, it varies, because they're not trying to consistently get a certain yield. They have been getting around a 36%, but I asked him, now that times are changing and funds are falling, are you gonna still specify that you want growth over income? Could we see a pullback in the distributions? And we talked all about it. Very, very interesting, but it kind of showcases that they have to select what they're gonna do. Do you want a 50% distribution rate and a 30% NAV decline rate over time? Is that something you would invest in? Would you invest in something with a 5% growth rate and a 10% distribution rate? Well, probably not, because a lot of investors don't. There's already funds like that by Neos, by Tap Alpha. And so YieldMax does have a specific place in this ETF market that they're kind of moving out of now. They're kind of conforming, I will say, and I don't think it's a bad thing. I do think that they are going to struggle with a lot of these single option income ETFs, even though some of them have done phenomenally well over time. Nvdia, I think PLTY has been doing good, HOOY, and of course, you know, MSTY. But things are changing. And if we go into a bad market, I think these will completely bleed out with their AUMs. I think people will continue to pull money out of them because it's just scary. They do have their short single stock positions like WNTR. Winter has been doing really well as MSTR has fallen significantly. But it's kind of a one-off, I will say. So who knows if these funds are going to work or not. Now what we're going to do, we're going to look at the underlying. We're going to look at Nvidia, MSTR, and Tesla. Oh, couldn't come up with that last name. And we're going to see the performance, and I'm going to give you my opinion on if I think these are going to work or not work in YieldMax's favor. Another important point to make with these new funds is the credit call spread could be utilized to generate some nice yield and also prevent some NAV erosion. So I understand why they're going with this as kind of the main strategy, whereas they don't have to just try and make 100% yields every single 6 months, every single year, just to try to keep up with their own kind of standard. Now, this niche, this still high income space, but no NAV erosion space, could do really well for YieldMax. I'm definitely not going to be buying these right away. I want to watch and see how they perform, and I will be tracking them specifically. And I guarantee that we can see more of these in the future, especially if these grow in popularity. The key factor with YieldMax is, have they kind of squandered their relationship with investors with how these things have been going on with the reverse split news that was devastating? And are people even going to look twice at these just because they're YieldMax funds? Well, we can see over the last year, we've had quite a good return from Tesla and Nvidia. Tesla's sitting up 15%, not great. Nvidia's up 31% and MSTR is down 57%. But at one point, MSTR was actually in the positive by 13%. So not great by any means as this year's gone on for MSTR. But maybe it's time for this thing to rebound. Maybe if crypto levels out, we could see this one do relatively well. Now, I'm really interested in how these perform against their competitors, because we have XPay from Roundhill, and then we have our three, like I stated earlier, from Rex, but those are not really targeting growth. They probably have it in there as a secondary or tertiary part of the fund, but they just want that 20% targeted distribution rate and trying to kind of maintain the NAV rather than trying to push some growth. And I'll be honest, I'm guessing that that's what YieldMax is going to end up doing. I guarantee they probably get at least a 20% yield, and if they go much above 20 to 30%, that's where you're going to start seeing the opposite happen in NAV erosion over time, because then they're just playing it too risky with the options. So those really are my thoughts. I'm not buying them anytime soon. I will be tracking them, so don't forget to like the video and to subscribe if you want to see how they do, or if you want to see if they get squashed by their competition, or if you want to just keep up to date on the weekly dividend ETFs, because that is kind of my bread and butter. It is my favorite thing to talk about on this channel. As for what I need from you, I want to know in the comments, will you be buying these? Are you interested at all in YieldMax, or have they kind of scared you off with the NAV erosion that we've seen across the board with most of their other funds? And if you are buying any of these, which one are you buying? Are we looking to buy MSTR at all-time lows on the year? Are we looking at Tesla maybe for a breakout year in 2026? Or are we thinking Nvidia will continue its trend to gain 30% every year until, I don't know, the AI bubble completely explodes? Let me know what you think in the comments. Don't forget, again, to like and subscribe, and I hope to see you in the next video.